Good morning, everyone. We're just going to give it another 30 seconds as people are kind of trickling in, and then we'll get kicked off.
I'll do something.
All right. Good morning. Welcome to the March monthly webinar. We're going to go ahead and get kicked off. I'm going to share my screen, and then we'll get moving. Okay, so just to kick things off, I'm Justin Ferraccio. I think everyone on the call should know me at this point. I'm out in the Denver office and a partner of the firm here. And this is Chuck Everly.
Hey, good morning.
And on the call today, we have Beckham Wyrick and David Wagner from Aptus. We'll let those guys introduce themselves in a little bit. Purpose of the call, Chuck and I, about a year and a half ago, decided instead of doing kind of like a monthly newsletter, we would do a webinar, try to keep it a little bit more interactive, a little bit more engaging. So as a reminder, everyone on the call is anonymous. You're welcome to ask questions. They come directly to me only. And then if we have time and they're group appropriate, we'll ask them. If not, I'll reach out to you individually, or Chuck will, and we'll discuss them if they're kind of a more personal nature. So markets, right? That's going to be a big thing to talk about today with, Aptus joining us as well. So you're going to notice some pretty big changes month over month. I think when we did this webinar in February, the Dow is now down 2.5%. So a 7% swing over the last 30 days. S&P is down 5%, which is an 8% swing over the last month. NASDAQ was up 2% in February. Now it's down 10%. So a 12% swing there and a 12% swing in the Russell. Equal weight is hanging in there pretty well. And, US bond ag is up a little bit. It was up maybe 0.5% before. So it's still climbing a little bit in the turbulent equity markets. I think something to note, which we touch on very often, is the NASDAQ and S&P, weighted by market cap, right? So when we see big percent swings, it's largely because, we're seeing big percent swings in some of the largest companies in the world. NVIDIA is taking a major hit. So is Apple, Google, you kind of name it. The Magnificent Seven have kind of come back to earth a little bit over the last 30 days. So kind of our average account and our average strategy, and again, it's more nuanced because we treat everyone individually and uniquely, but our average account is flat to down 2 or 3% for the year. Accounts with a little bit more growth focus are down a little bit more, but we're hanging in there very well, as we kind of typically do when things get turbulent and difficult. And that's a big part of our strategy and why you're with us. So I'm going to kick it over to Chuck to introduce the guys on the call here.
Hey, good morning, everybody. Yeah, it's kind of the, like if you think back to our previous calls, when you look at the things that contributed to performance the most last year, contributing most to the recent decline that we're seeing. So the more you own of those Magnificent Seven, the more you're seeing the decline. And that's why we're, the average portfolio is basically. So we got Aptus on the call today. We're super happy to have Beck and David on the call. So probably about a year ago, we started looking for adding more horsepower to the portfolio strategy. So we first looked at hiring a chartered financial analyst at the firm, looking at hiring a trader at the firm, and really went down that path as to what that would look like, how that would help us. And then we kind of switched gears and started looking for a firm outside of SevenBridge that align with our thoughts on capital markets, who could help us with our strategy. And as most of you know on the call, the core strategy is high quality dividend growth companies allocated by sector is the core of everybody's account. And then we use satellites around that to add growth, add fixed income. So we interviewed a number of firms. I'd say about 6 months ago, we engaged with Aptus. They have 9 chartered financial analysts at the firm. And I'll let them talk about how they see our role, but we see Aptus's role in supporting the work we do and giving us more depth to, what companies are in the portfolio, what sector weightings do we have? And also looking at, what are we doing? What could go wrong with what we're doing, and really analyze what pitfalls are out there and how to avoid them. So first question's for Beck.
Do you want to let them introduce themselves?
Oh, yeah. Why don't you guys, go ahead and, talk about your backgrounds and introduce yourselves.
Sure. Yeah. First and foremost, thank you guys for having us on the call, and thank you to the clients, for entertaining Dave and I on the call here, and letting us share a little bit about who we are and what we do. Yeah. So my name is Beckham Wyrick, CFA, as Chuck mentioned. Been with Aptus almost since the very beginning. The firm was established in 2013. I came aboard in 2016. I'm a partner in the firm, and have been kind of along the ride with our company from 3 people up to now over 40 employees that we have, kind of spanning all the geographies of the country. So I have done a little bit of everything at the firm. Right now, I sit kind of on our investment committee, and Dave and I will be delighted to support Chuck and Justin and you guys along your financial journey. So thank you for having us
Yeah.
on.
So I'm Dave Wagner. I've been with Aptus probably since 2017 or 18. I might have been employee number 5 or 6. So I've kind of been at the forefront of the firm, much like Beckham himself, also partner. But my specialty, my bailiwick, is going to come on the equity side of things. I'm head of equity, and I also focus on capital markets, economics, and really anything ingrained with the market as a whole on the equity side of things. Portfolio manager on a lot of our different active ETFs, but I also work alongside, great people like Justin and Chuck to really kind of give my insights of what I'm seeing that's going on underneath the hood of the market to make sure that we're positioned properly, looking out into the future.
Thanks, guys.
Thanks.
One question I'm getting from clients, so because we've introduced Aptus as a firm, to many people on this call, and the one question I get a lot is, hey, when I go on Aptus's website, it seems like they're doing something different than what they're doing for SevenBridge. So, Beck, if you could address that, just kind of, how do you view your role in supporting SevenBridge and the clients of SevenBridge?
Sure. No, that's a great question. And I think, like you said, looking at our website, it's kind of hard to decipher what we do right off of the bat. I think, when you boil it down, what is our job, or why do we exist as a firm? And I think the simple answer to that question is really to impact advisors, and through advisors impact clients, for the better, obviously. And I think our biggest job, and the way that I see us um, supporting you guys in our role in this relationship, is really just making your and Justin's lives easier. So allowing you guys the time, giving you support from an investment perspective to have confidence in what you're doing. We're kind of the team behind your team. So you mentioned the CFA expertise. We do have 10 CFAs that kind of have expertise in various different areas of the market, from fixed income to equities to private equity to capital markets overall, right? So really coming alongside you and Justin, one, providing kind of that macro commentary and support, just overall, hey, how do things look out in the market? And then 2, bringing that down to the portfolio level, is kind of coming alongside of you guys and giving you a second set of eyes, and a second opinion on kind of the way that things are being constructed at the portfolio level. One, from the stock bond mix, but 2, kind of, you mentioned coming into the call, is, hey, the majority of your investment strategy really relies around owning individual stocks and sectors. So giving you guys commentary, individual stock analysis, individual fund analysis, those are the areas where we really see ourselves providing most of the support from a kind of investment perspective. I think on the operational side, there'll be some advantages that your team can take from us as well, but really just in a supporting role, kind of we feel like we're a white glove, white service type of firm, and that's what we're here to provide. So hopefully that helps a little bit.
You know, I know one thing when we were going through the search process, what we found is many of the firms that provide a service like Aptus have kind of the efficient frontier model mentality where, as clients know very well, you know, we look at diversifying assets by sector of the economy more than by, are you large cap growth or you large cap value or emerging markets, you know, and kind of that pie mentality. And we had, you know, as we went through the firms, most firms were just doing that. And, you know, we felt we aligned the best with Aptus. Aptus is an equity firm. You know, if you ask me and Justin and you ask the guys on the call, we love equities as a way to build wealth. We use fixed income to kind of round it out and smooth out the edges. But when you get right down to it, it's all about equities, getting performance there and also managing risk from that perspective as well.
Definitely, and I do think that's one thing that you guys do a great job within your process of doing is right. Like, hey, talk about kind of the two risks that clients face. One, you have obviously drawdown risk and market correction risk, which comes with owning equities, and then secondarily, kind of longevity risk, which is essentially the risk of not compounding capital at a sufficient rate to meet the returns that you need, kind of to make your plan work. So I really like. I think this is something that Dave and I talked about and really attractive about your firm is the way that you do that within your equity process to where within the sectors owning stocks that one give you the opportunity for capital appreciation on the upside, but then also owning quality firms, dividend oriented firms that provide an element of downside protection, kind of like we're seeing in the markets now when things get rocky. So that's one thing that really we liked about SevenBridge coming into this relationship as well.
Great. So next question, we'll go to Dave. This should be an easy one because there's not much volatility out there. But you know, stock market obviously doesn't like uncertainty, right? And there's a lot of uncertainty out there right now. So if you give kind of a high level capital markets overview of what you see happening now, we're getting, you know, a lot of questions around tariffs and how that's going to impact the market long term, short term. So just kind of, you know, give your high level view of what's going on, and I'm sure we'll get questions along the way.
Yeah, let's have some fun with this too. So if anyone's had any questions, definitely throw them in, you know, between myself, Chuck, Justin, and Beckham. We can probably answer anything and everything under the sun because there's a lot of stuff going on right now, whether it's in the markets or coming out of Washington, D.C. There's a lot of noise. And as Justin mentioned, you know, the market loves certainty and it hates uncertainty. And right now we're kind of in a short-term, hopefully short-term environment where the market is focusing on the latter right now from uncertainty. As Justin started the call, he's correct. You know, the market has started to see a few pullbacks, whether you're looking at the Dow Jones, the NASDAQ, or the S&P 500, you know, really since the recent all-time high on February 19th. In fact, the S&P 500, which is my favorite gauge or mechanism to look at the U.S. domestic stock market, it's pulled back 9.5%. And I think that's created a lot of worry out there in the market. One, because you're getting price volatility with the market, but then there's a lot of emotional volatility out there coming out of Washington, D.C., because there's a lot of headline risk. I mean, it feels like every single day we have a new headline coming out. Hey, we're going to have tariffs come out on April 2nd. Oh, we've rolled some back just today. You know, you had steel and aluminum tariffs come in on Canada. So there's a lot of noise out there. But how I like to look at the world is, you know, I want to look at it, one, as a rational optimist, but two, I want to try to make sure that a lot of the messaging that we provide at SevenBridge and Aptus is very palatable to understand, where we can show our conviction on where the market will be heading out into the future. But the market has seen a pullback. But I want to make sure that people know that pullbacks, they're healthy and they're normal. They happen all the time. As I just mentioned, the S&P 500 has pulled back 9.5% since February 19th. Well, on an annualized normal calendar year, the market tends to see 3 different pullbacks of 5% or greater. If you actually take it a step further, the market tends to see 10% pullback within a calendar year. And I would say pullbacks are normal, they're healthy, And I think it's a great way to right size kind of the risk in the market so you can kind of continue to go higher up into the future. But if you were looking at this pullback as like, what's the genesis? What's the rationale why we've seen this, 9.5% pullback from all-time highs? I would say it's actually coming from the growth side of the ledger. We just came out of earnings season, and a lot of companies, one, yes, they're skeptical on putting out some type of guidance given the uncertainty in Washington, D.C., but we're just seeing a slowdown right now within the economy. That's also natural, especially when we've been kind of punching above our weight class over the last 2, 3, or 4 years. I would say the tariff side of the situation is really causing the intraday volatility. Growth is causing the pullback. The tariff side of things are really causing the overall volatility. And I think one thing that myself, Justin, Chuck, and Beckham are good at, we're really good at analyzing what's going on underneath the hood of the S&P 500. That means in financial terms that we like to follow the tape, because at the end of the day, the market is the number one arbitrator out there. It's always going to be 100% correct. And if you have the ability to follow the tape and what the market is telling you, you're going to have a better opportunity to invest with the wind at your back to be successful more often. And a few of those things that we're seeing kind of underneath the hood of the market right now is that you're having the defensive stocks outperform the cyclical stocks, which is kind of an anomaly when you see the 10-year interest rate pull back from 4.8% to about 4.2%. Usually cyclicals outperform there, but right now defensives are outperforming cyclicals. So that's the market telling us something that, hey, we're focused a little bit more on growth right now. And even if you take that a step forward, you're seeing large caps here domestically outperform the domestic small caps, which is also kind of another lever or mechanism to really look at what the market's telling you. And it's that, hey, you know what? That means that growth might be pulling back a bit. To tie things together, and Justin, I could talk about tariffs if you would like, growth is pulling back, but it's not in like, oh my God territory. Just last quarter, the market grew earnings per share by 16%, which is an astronomically amazing number. Historically speaking, the markets grew on earnings per share like 7 to 9%, but you're just starting to see that pullback of 16% earnings per share growth last quarter turn into 11% earnings per share growth in the first quarter of this year. And that's just spooking the market a little bit. But all in all, I'm not worried about this market right now. There's a lot of headline volatility out there, a lot of emotional volatility, but at the end of the day, we need to, be agnostic about politics and invest, in the current environment, given the hand of cards that, we need to play, and pullbacks are healthy and they're normal. And I wouldn't let this worry you one bit right now.
Yeah, it seems like most of the data we're looking at, you look at, the economic data, the different surveys that are out there, there's really nothing that's pointing to a recession. As far as you look at manufacturing, you look at services, all the data is not pointing towards what the headline of the media is saying. I think that there's a disconnect with what the media is talking about and what the data is telling us.
Yeah, you're exactly correct. So there's kind of two different sets of data points that you have out there in the market. One's called soft data, and the other's called hard data. Soft data are basically just surveys that they put out there into the market to gauge people's feelings and interest. Hard data is actual tangible output data. And right now the soft data looks weak, but the hard data is actually still pretty strong. There's a survey that comes out. It's called the AAII survey, and it kind of gauges two things. It gauges where the bullishness, which means you're an optimist, or the bearishness you're in the market. That means if you're a pessimist. And then also asks you kind of where you're positioned. And it's saying two different things. It's kind of saying, on the feelings and the sentiment perspective, we're getting one of the worst readings ever. So the most bearish readings ever. It's actually the 7th largest bearish reading we've ever seen in the survey going back to the 1990s. But if you look at like the hard tangible data, all those people that they asked who seemed very bearish on sentiment, they're still very much overweight stocks relative to bonds. So it's kind of like do as I say, not as I do right now. So it's just kind of conflicting data out there.
I think what's interesting too, that the higher the pessimism gets, the more of a bullish signal it is, right? So it's almost good to see people being pessimistic because it's actually a positive, right?
Yeah, that's 100% correct. So I mentioned that this was the 7th worst reading that we've seen in this kind of sentiment gauge of consumer investors. Well, it's tend to very closely coincide with market bottom. So you're exactly correct. It's a contraindicator.
Yeah, it's almost good to see high pessimism.
Absolutely.
All right, Dave, we got a few questions. If you can, we'll quickly go through them. The first one is, you mentioned you use the S&P 500 kind of as your gold standard for, measuring market health or performance. Why do you think that's the gold standard?
Yeah. So let's just say that there's three kind of benchmarks out there here in the United States, okay, excluding small caps. You're going to have the NASDAQ, you're going to have the S&P 500, and then you're going to have the Dow Jones Industrial Average. The Dow Jones Industrial Average, the last one I stated right there, it's going to be a little bit more focused on the industrial side of the market. That index has evolved over time where it's not as, concentrated on industrials themselves, but this is going to be a stock price weighted benchmark, which I prefer to use market, weighted benchmarks. And that's what you get out of the S&P 500. The S&P 500 basically weights stocks by their market capitalization size instead of making them kind of equal weight or based off their stock price, which is kind of an arbitrary number in general that the Dow Jones Industrial Average uses. I know Donald Trump, current President Donald Trump, tends to focus more towards the Dow Jones Industrial Average. That was kind of the gold standard back in the day. But I think the market's evolved into focusing more at the S&P 500 more recently. If you look at the third, and actually the first index that I mentioned, it's going to be the NASDAQ. That's going to be more of a concentration on information technology stocks. So that's going to be a great gauge of kind of the innovation in our country. But that's still not kind of a well-rounded benchmark in my mind, while the S&P 500 is very much more well-rounded. It has the industrial stocks like the Dow Jones, has the tech stocks like the NASDAQ, but then it also has, comm services, your utilities, your more defensive areas like staples, real estate, and then you have some more cyclical areas like energy and consumer discretionary. So it's just a more well-rounded benchmark, in my opinion.
Awesome. Thank you. Do you expect a recession? There's been some talk recently, even coming from President Trump. And so that's on some people's minds right now. I'd just love to hear what your thoughts. Easy one.
It's probably, yeah. Let me get my crystal ball out. If I knew the answer to that question, I think I'd be a happy man in the future. But I don't know that. Wish I was Nostradamus. But I would say let's just look at the statistics and look at the facts. And I would say it's very difficult for the market. Well, actually, let me take a step back. Let's define a recession, because there's a lot of different thoughts out there on what's considered a recession. And the definition of recession kind of falls in two different definitions, in my opinion. Okay. The first one is going to be kind of the long-standing historical definition, and that's when you get back-to-back quarters of negative GDP growth, okay? We haven't had a negative GDP quarter probably in the last 3 or 4 years, and it doesn't look like that's going to happen in the near term once some wonky data that I don't want to get into kind of reconciles its way out. So the overall definition is back-to-back quarters of negative GDP growth. The way other people like to look at it is actually from a market movement perspective, because that's going to give you a more real-time indicator as what's going on in the market if we are in a recession. So people kind of like to look at the 10% pullback as kind of a correction phase, and we're very close to that right now. But once you hit that 20% peak to trough drawdown greater than 20%, that's what some people start to consider some type of recession. So we're about half of the way there. So that tells me that the market's not fully pricing in a recession now. Once we get closer to that 20% threshold, that's the market saying, if you follow it, say, hey, we might see some economic uncertainty moving forward into the future. But as to my personal opinion, will we see a recession? In the future, we have to. I don't know if it's this year, next year, or further down the road. But I always like looking to two different North Stars, which isn't possible, but let's just go with it. Let's look at the health of the consumer, and let's look at the health of businesses around the United States. And right now, the consumer themselves, even in the face of heightened inflation or structurally higher inflation that we've witnessed over the last 3 years, the consumer remains very strong. If you look at the health of the consumer, and I look at their net wealth at a household level, if you look at it over the last 10 years, the average net wealth of an average U.S. home or household, has increased by about 100%. And that's in the face of, the 3 years in a row of really heightened inflation. And then you also look at the propensity of the consumer to spend. On a year-over-year basis, the consumer spending at a clip 6.5% greater than last year. And that's kicking above its historical weight class. Historically, on an annualized basis, the consumer grows like 3% to 6%. And right now, hitting at 6.5%. So I'd say the consumer's strong. I think sentiment is weak, but the number's still strong. If you look at the health of the businesses right now, they have a lot of different levers to pull in an inflationary environment, whether they're going to eat those costs or pass them on to consumers. So if you give them the optionality of either one of those things, like you're still seeing a lot of these businesses continue to grow. As I just mentioned about 5 minutes ago, during last quarter, Q4 2024, earnings per share of all the companies in the S&P 500 on a weighted average basis grew 16%, still 11% next quarter here in Q1 2025. I would say that the businesses still remain very healthy, especially if you look at it from a profitability standpoint. If you look at the S&P 500, the gold standards of indices, in my opinion, they've never had an operating margin, which is a gauge of profitability, this high ever. So I would say things look pretty good for the consumer still and for the U.S. businesses. But again, that's kind of looking in hindsight. You still have to look through the windshield, not the rear view mirror. But right now, it's very difficult, especially with the labor environment. Being at full employment and wage growth still at 4%, it might be difficult to get pushed into a recession. I mean, I'm not saying that can't happen. I think some policies out of DC could move us closer towards a recession into the future, which could deviate some of that consumer spending and some of the U.S. business health out there in the United States. But right now, the market's not pricing in a recession, in my opinion.
Fantastic. Can you touch on, your thoughts on it? There's a lot of employment data coming out, a lot of kind of fear around potential job cuts moving forward, especially in the federal level, and how that's going to trickle into the economy.
Yeah, great question right now. And I think outside of tariffs, a lot of the questions that we're getting is around, Elon Musk and Vivek Ramaswamy in regards to Doge. And last week, we got a lot of important information, in my opinion. Last week, we got 3 data sets that came out. The first was on Wednesday with the ADP payrolls report. That's kind of a gauge of the private sector's jobs. And then on Thursday, you had something come out called the Challenger report. And that's kind of you looking at the gauge for government jobs, so the public sector. And then on Friday, we had the overall non-farm payrolls number, which is an overall gauge of, privates and government jobs holistically. And also with that report on last Friday comes with the unemployment rate. So if we walk through each one of those, on Wednesday, the ADP report, you saw private jobs kind of pull back a little bit by about 77,000. So I would say over the last 3-4 years, the majority of the job growth that we've had in this country has actually come from the public side, not the private side. And I think the more jaw-dropping data we got last week was on Thursday with the Challenger report. It's usually a report that no one ever looks at. It hasn't really been looked at since July of 2020. And we had the worst reading since July of 2020 in this report because we saw 63,000 government jobs get cut over the last month or so. A lot of those were voluntary with a lot of programs put out there by Doge for people to retire but overall, to bring it holistic, and we can look at any data point. I think you have to look at a time series analysis of data points. So data points over a span of a few months. We saw some cracks in the labor market last week. We've seen a few from a seasonality perspective over the last few months, but nothing is really jaw-dropping crazy for me from a holistic standpoint because we still have grown a substantial amount of jobs over the last few years. The job openings number actually just came out about 15 minutes ago, and there's still a lot of job openings. So there's a lot of people, opportunity for people to move laterally, and you're still getting wage growth close to 4%, which is above historical standards. I think that you're starting to see cracks there, but they're very minor in nature. And I would say as long as the labor market remains strong, so will the consumer remain strong. So this labor data, Justin, that you asked, is very important, but it's not worrisome yet.
Fantastic. Well, we actually got a lot of questions. We didn't get to a handful more, which is great. We love the participation. We'll reach out to the people's questions we didn't answer directly and talk with you about them. But we do have one more I think is worth doing quickly, and this one's for Chuck. So obviously, you guys brought Aptus into SevenBridge. How is that cost going to affect me as a client of the firm?
I'm glad somebody asked that, because I've been getting that question individually. So just as if we would have hired internally, that would have been a cost that the firm would have absorbed. And we look at you know, engaging with Aptus, that's a cost that the firm will absorb. We're not raising our fees to you because we hired Aptus. So your fees remain the same, but you just get a lot more now. So it's a value add. But I feel bad for Beck that he didn't get to answer a lot of questions, but you know, Beck and his team are integral to the relationship. And we'll have these guys on more in the future. You know, people on the call and the people that hear this on the recording of the video, you know, ask us questions that you have about the relationship with Aptus. You know, how does it make what SevenBridge does better? You know, how does it make your result better? You know, so I'm anxious to hear your thoughts on this call, what you want to know more about Aptus, and also subjects for future calls. Lately, you know, the market's been providing us plenty of material to talk about each month. So, but if there's something you're interested in, you know, please reach out to us. You know, that's what we want to cover, what's important to you on these calls.
Dave, when's the next time we can catch you on TV? I know you do a lot of contributions.
They put me in the right spot on Saturday. I did CNBC radio because I'm probably better at that than actual TV. But a CNBC tomorrow and a Fox Business a few times next week.
All right, fantastic. We'll get some clips out. Appreciate you both very much. And thank you all for joining, taking time with us. I know it's supposed to be 15 minutes, but I think this was worth everyone's time.
Sorry.
So thank you. No, it's
our fault.
It always goes over. Change it to 30.
Appreciate y'all so much. Thanks for having us.
Thanks
Thank
for
you for
having
being
me.
on. Thank you for having us.
See you.
Have
Bye.
a great day.